Tax planning is not about filing your taxes. It's about minimizing taxes over your lifetime. So what is tax planning? Here are some common strategies. Number one, Roth conversions. We've all heard about it. It's about moving money from pre-tax accounts, such as your 401k, into a Roth account and voluntarily paying taxes before they're due. The idea being you're going to pay taxes at a low tax bracket because it's a low income year to avoid paying taxes later on when you're in a high tax bracket. It also will reduce RMDs, required minimum distributions, that start when you're 73. Number two, tax gain harvesting. This is one of my favorite ones because not a lot of people know about it. Tax gain harvesting is about taking advantage of the 0% federal long-term capital gains tax rate, which is a real thing for people in a very low income tax bracket. A married couple with adjusted gross income of under about $90,000 will have a 0% federal income tax bracket. Good time to sell appreciated stock. Number three, tax loss harvesting. This is about selling investment positions that are currently at a loss and replacing it with something similar. So you're still captured in the market, but you're able to claim some or all of that tax loss on your tax return the following year. Number four, qualified charitable distributions, QCDs for short. If you're over 70 and a half years old, you can make a donation to your charity directly from your IRA, which is usually more tax efficient than simply claiming that as a charitable deduction. Number five, donating appreciated stock. You can deduct the entire value of any stock that you donate, and the capital gains that are embedded in it go poof. These last two strategies are for people who are still saving and working. Number six, using the right types of accounts while saving for retirement. Sometimes it makes sense to focus on your Roth 401k, and more often it makes sense to do a combination of both. It also might make sense to cut back on 401k contributions and focus on a regular old taxable brokerage account instead. Number seven, if you have the cash flow to support it, you might have access to something called a mega backdoor Roth 401k. I've covered this in another video, but essentially if you've maxed out your regular 401k contributions, both pre-tax and Roth, you might be able to put $10,000, $20,000, $30,000 more into something called an after-tax contribution bucket, which is then converted to a Roth account, i.e. a mega backdoor Roth. Tax planning is about maximizing after-tax wealth. You do this by coordinating which buckets you save and withdraw from over your lifetime, not just in a single year. If you have tax planning questions or want to schedule a call, see the link in my bio. Thank you.